Welcome to Leaders in Lending. I'm your host, Jeff Keldner. This week's episode features my conversation with Rick Jarrar, the Chief Lending Officer at Kemba Credit Union. I love talking to Rick. Kemba shares a home with our second headquarters in Columbus, Ohio, and we really dove into a lot of interesting topics, including how you think about loyalty in a digital age, the role of branches. Rick had a phrase that we should be digital first, but not digital only, which I really liked. And he really focused on providing quality, what he called pleasant experience, and that being the starting point for lots of discussions of digital, not digital, kind of how you build technology. We even dove into crypto at the end, which I thought was really interesting. So please enjoy this conversation with Rick Jarrar. Rick, thanks for making the time and joining the podcast today. I really appreciate it.
My pleasure. Thank you, Jeff. I'm glad to be here.
Yeah, you guys share a physical location in Columbus, not an office space, but I know we have our second home in Columbus, and you guys are Columbus based. I've been to your offices, so I love the Ohio connection. It's a great town.
It is. Columbus is a beautiful city. I'm happy to be here. I've only been here for about 7, maybe 8 months since moving from Memphis, but I'll tell you, it's been awesome so far. And your office, it's in a great part of Columbus. A lot of good food around there.
It is. There's a lot of good food, good places to go and eat or grab a drink. It is a fun town and a fun part of town. I've been there a few times and enjoyed it.
Absolutely, we're loving it.
Yeah, I thought I'd start the conversation off with the question of loyalty and how you think about what it was historically. Maybe we'll start with the kind of like the status quo or the old version of what earned you loyalty as a financial institution, over time with customers in the past, and then we can dive into how you think that maybe that's shifting in a digital age, if it's shifting. But what do you think was the core of what caused a consumer to be loyal to a particular financial institution?
Jeff, in the old days, and my son laughs at me every time I say that. In the old days, loyalty really was a product of locality and a friend or a family member referral. You wanted to do business with a bank or some kind of another business, another retailer. Usually found somebody who was nearby, and you asked around. Well, I mean, today we sort of still do the same thing when we look at Google reviews, right, to evaluate a business. But we let me take a step back a little bit. We as bankers or financial institution executives, we've for years talked about increasing the share of wallet. Customers, members, whatever. If you look at your own wallet, if I were to pull out my own wallet now, I'm willing to bet that you have cards from 3 or 4 different institutions. And I think one of the things that we as bankers have to accept is that is it okay or contemplate, is it okay for our members to do business with 3 or 4 different institutions? Why is it that we insist that we become the primary financial institution? Maybe we need to consider changing that first P from primary to permanent. Meaning, if I am a great auto financer, if I'm a great auto lender, and I've got members that have borrowed money from me to buy cars for the last 10 or 15 years, what is wrong with that? Maybe that's a concept that we need to understand. So, and shifting back to your question of loyalty has shifted to where it is now a loyalty to an experience rather than a service provider. If you look at if you look at a company like Facebook, Facebook taught us many years ago that you could have a relationship with somebody or a friendship with somebody who you have never ever met. It could be a person in China that you've never met and you're never ever going to meet. You've never had a conversation with them and you're never going to have a conversation with them, but you still call this person a friend and you still maintain a relationship with them of some sort. What is wrong with taking that concept and applying it to the financial services industry? There's, I talked about the loyalty to the experience. There's plenty of recent research that proves that point. Look at Amazon, for example, and you and I sort of threw this around a little bit before. Amazon's prices are not the cheapest. They're competitive, but they provide a great customer experience every single time. If your product is late, they're transparent. They tell you the product is late, and if you ask, they'll even compensate you for that delay. So again, what if we as financial institutions aimed at relationships or began to look at relationships as a single product. And I know if my boss heard me say this, he would probably yell at me. Because we, along with all other institutions, we're all about engagement and we're all about
Hmm.
having multiple products. But if we were to give members, if we were to give consumers the option, the choice to choose where they want to pick their products, if every institution, or if we employ the hedgehog concept, meaning identify what you do best and do it better
Hmm.
than anybody else, then the member or the consumer will end up having the best experience really in just about every product that they could potentially want to
Hmm.
buy. So there's loyalty programs really, if you think about them, unless you do them at the scale of American Express, they're tough. But even if you look at those things, they are a single product loyalty program. American Express doesn't expect you to finance your house with them or to buy a life insurance policy from them. So we as financial institutions still want that multi-product
Hmm.
relationship, and we can have it if we can create an experience that the member would be loyal to in every product that we could potentially develop. So, in
Hmm.
summary, in my view, the concentration or the focus really should be by the institutions, if we want to create true loyalty, is to focus on the experience that the member goes through to get any product that we have, not necessarily the pricing, and
Hmm.
not necessarily any other component. I think the experience, and we've learned this from the introduction of the iPhone all the way to the end of the coronavirus pandemic, where the experience has really determined which businesses survived and which businesses did not survive.
Yeah, that's really fascinating. I'd love to dive into what you think differentiates the high quality experience. I do want to ask this first because your messages really want a little bit of like focus on the thing that you're going to be really good. I mean, that hedgehog concept, I love. I've read that book many times. Um, and this idea of like focusing on what you can be best in the world at and not trying to be all things to all people. And it runs counter to, I think, how many financial institutions have operated. And frankly, the playbook that most of the challenger banks or neo banks are taking, which is what I see from at least some of them, not all of them, but is a rush to have as many products as available as possible, often at the cost of a poorly
Mhm.
integrated experience, a poorly optimized experience, maybe a lot of outsourcing where there's like lots of pieces that are kind of like not great, but hey, we've got to be able to do the home buy and the car buy and the line of credit and the personal loan and the credit card and the deposit. And so they're getting a lot of breadth, but maybe not the optimal experience. So I'd love to get your take on how you think about picking what is your key focus, from that hedgehog where you really want to differentiate, and then what it takes to be, what it means to be the best in class experience in this kind of more digital, at least digitally facilitated age.
Sure, Jeff. Look at the evolution of fintechs. The thing that has made fintechs as popular as they are today is the experience, is the journey that is a consumer journey.
Mm-hmm.
Um, when fintechs first came on the scene, we call them disruptors. They were seen as a big threat. I'll tell you what,
Mm-hmm.
I thought they were the greatest thing to ever come onto the financial services industry from day one. And I didn't see them as a threat. When I saw what I would have to go through to take a personal loan from
Mm-hmm.
my local bank or savings and loan or credit union or whatever, compared to what I would do if I were to go to Upstart, clearly it's night and day. And when you look at that and you compare those two experiences, it is easily, you can tell who the winner is going to be in the long run.
Mm-hmm.
Take let's talk about fintechs. Upstart in particular. Um, Short application, very
Mm-hmm.
very little friction, not invasive, at least not on the front end when we're getting information from the member,
Mm-hmm.
um, and the member is done. Compare
Mm-hmm.
that to a traditional personal loan, unsecured personal loan experience through a bank, 5 years ago, where you had to, practically give your firstborn. Um, it very, very, very different. So when we talk about experience and when we talk about the member journey, it's all about providing the consumer with what they want, how they want it, and where they want it, and when they want it. asking the member to complete an application that has 45 fields to get a personal loan or a car loan or even a mortgage these days is
Mm-hmm.
ridiculous.
Mm-hmm.
The journey, that consumer experience has to be so streamlined that it has to be literally pleasant. The consumer should be able to get online, and I tell you, I preach about this so much at Kemba that I think people are either really jumping along for the coming along for the ride, or they're getting tired of me, singing this song. The my expectation is my member is going to get online, apply for a loan, and then look at their spouse and say, "What, is that it?" And
Yeah,
then the
yeah.
second piece of it, of course, is that we get them whatever they need, whether it's money or credit card or whatever, without them having to pick up the phone, without anybody having to pick up the phone and saying, "Hey, did you do this? And here's what we need to." No, there's no "here's what we need to do." Here's what I'm the consumer. Here's what I want. Here's when I want it, and here's where I want it. One of the
Mm-hmm.
things that I personally dream about, Jeff, is to get to a point where I can, while I'm sitting in bed on Sunday morning, I can stick my head up and say, "Alexa, I want to buy a 2019 Coach RV. Find one for me and find me financing." And that's it. And I think in a number of years, we could potentially get to that point. And so you talk about the member experience.
Mm-hmm.
Um, do I like going down to Target every once in a while and walk the aisles? Sure. Yeah, I do. I guess just to have some human interaction, especially coming out of COVID.
Yeah,
But
yeah.
the member experience really has to be. Stephen Jobs said it best. He said, find out what your customer wants, and then build around that. Don't go buy a system and then and begin to implement it and say, well, let's see how we can make this work for our customers.
Mm.
It doesn't work that way. You've got to identify what the member wants and then build everything that you do, whether it's systems or processes or even talent, around what your customer base is. It's all, in my view, it is all about the customer experience these days.
I love that message, and I feel like it's one that gets lost. Sometimes I get this, the topic of digitization is top of mind for everybody. I feel like everybody wants to talk about going digital, and I've seen digital experiences that didn't have this mindset. Where I went to my bank and they gave me the same 45 questions as if I was a guy walking up on the street, and I said, you're asking me about, like, you call me about a mortgage refi, and you're asking me where the address of the home is, like.
Right.
You know that
Right.
this is, I'm responding to your mail and you're asking me my name and my date of birth, and like you've got to, like, they got the digital checkbox, but they didn't focus on delivering that kind of easy, seamless, pleasant, if you will, member experience. And I feel like
Right.
it's a great message, because it so often gets forgotten in the rush to be quote unquote digital. That digital is not just like yes or no. There's a quality of experience element that you really have to think about getting right if you want to earn business from consumers these days.
Absolutely. Have you ever tried to cancel or change a flight online?
I
You'll get the
have.
option, but it's a pain. It really is. It's a pain, and it's not a pleasant experience. You can book easily online, but if
Hmm.
you need to make any changes, it's not a pleasant experience. And I think that's something that the airline industry is going to have to look at some point in the future.
Or God forbid you have to cancel not a flight, but like try and cancel a subscription. Like I feel like there should be a law against allowing me to sign up for a subscription online unless I can cancel it just as easily online. But they're often like, please call this 800 number and wait 30 minutes on hold to cancel the
Yeah.
subscription you signed up for in 30 seconds. And I go, that doesn't seem like a good experience.
Yep.
How do you think about the role of the physical presence? I mean, we talked about you guys being in Columbus and near our physical office. We still have them. I'm assuming you still have branches and physical presences. We talked about this kind of frictionless experience that's really digitally facilitated. How do you think about the role of the brick and mortar experience, the branch experience for the modern consumer?
Jeff, back in the 70s, I believe, not that I was working in the 70s, when ATMs first came out, people said, "Hey, this is the death of the branch, and this is the death of the teller position."
Mm,
Fast forward, internet came on the scene, and online banking came on the scene, and people said, "Hey, here's the death of the branch, the physical branch."
hmm
They're still around. I think digital the way to look at the digital strategy is not to say digital only. You've got to
Mm,
go digital first, but you have to
interesting.
augment it with a human touch. Again, I gave the example of if you needed to change a flight or cancel a flight or a subscription, like you mentioned, there are a lot of things that you still cannot do exclusively online. PricewaterhouseCoopers did a survey back in 2019, obviously before the pandemic, that showed that 60% of consumers still want to get in touch with a human when they're dealing with a complex product such as a mortgage loan.
Hmm.
Branches have evolved over the years. I don't think you could walk into a branch anywhere in the world today, into a 5,000 square foot branch with the huge pillars and the huge
Hmm.
offices and the huge mahogany desks. They've evolved to where they're a lot smaller now. And
Hmm.
if you notice, every 3 or 4 years, there's a new phase. I worked overseas for a number of years, and back in, I want to say, 2009, the
Hmm.
bank that I was with experimented with a complete 100% digital branch, no human interaction. We had an ATM that could print checkbooks and that could issue cashier's checks. We had
Wow.
truly sophisticated equipment. We had iPads all over the place, so customers could come in and do whatever it is that they wanted to do. But that was not enough. We found out that at some point we had to put at least one employee there who would sit there and just ask questions, or at the very least teach people how to use this technology. So exclusive digital has worked for some organizations. I mean, there's a 14 $15 billion credit union out of Illinois. I think it's Alliant.
Hmm.
They have one branch, and they're doing it well. So obviously they've figured out the secret. I think digital first is the way to go, but it has to
Hmm.
be augmented by a human interaction of some sort. I think branches will continue to serve a purpose, but that purpose is going to evolve. Now, interestingly, if you talk to an architectural firm who specializes in designing bank branches, they're going to tell you that the branch model is here to stay, and it's got to be,
Of
at least
course.
2,000 square feet, and it's got to have a, rotunda, and it's got to have this and that, versus a company that specializes in digital member acquisition or digital member engagement. They will try and convince you day and night that the brick and mortar model is dead and you've got to go 100% digital. Somewhere in between, there has to be a balance. We have found that, if the way that we approach our members and the way that we want to take care of our members and serve them, our engagement with them really is done on a consultative concept,
Mm.
not on a selling concept. And it's difficult to do that digitally. You can present products, you can
Hmm.
highlight features, benefits, you can offer a seamless, easy way to sell the product or to fulfill the product to the consumer, to the member. But as far as consultation, one-on-one type of consultation, we have found that there continues to be great value in that one-on-one relationship. Facebook be damned with their long distance China relationships. We found a balance. I think we're still trying to figure out the right balance between the digital and the human touch. But I
And
think branches are here to stay, but they will continue to evolve over time.
well, your use of the word evolve a couple times just makes me want to ask a question. Evolve into what? What do you think the future of the branch looks like? I think the consultative topic is one I've heard a lot. This idea of like, how do I move my branch to more of an advisory capacity and less of a fulfillment, selling, processing, kind of transactional experience. But what do you think the branch itself evolves into? Not to ask you to play architecture design guy on the podcast for a little bit, but what does that experience look like? What is it? Where does it go if it's evolving to where?
It's going to have to be a smaller footprint
Mm-hmm.
with a combination presence of digital and human. It doesn't have to
Mm-hmm.
be, like I said, it doesn't. It will not be a 5,000 square foot space unless you plan to have a somewhat of a community center where
Mm-hmm.
you allow folks throughout the community to come and hold meetings and that sort of thing. And I think we've seen some value in that as well. But I think eventually the branch is going to have to continue to, and I'll use the same word again, to evolve based on the consumer trends, and based on what your local market needs. In some rural communities, there's still great value in the face-to-face and the personal relationships. And in those
Hmm.
communities, yeah, you do have to have more focus on that. So I think, Jeff, the key is to identify what your market needs are.
Hmm.
And markets are unique one from the other. And
Sure.
once you've figured out what your market needs, then you should be agile enough to and you should be agile and flexible enough to where in this part of the state or in this part of town you need to have a 3,000 square foot branch, and in this part of the state you could get away with 1,000 foot branch that has an interactive ATM that has iPads that where members can
Hmm.
transact, and you have one or two employees that would help members with whatever they need.
Yeah, the idea of digitally transacting in the branch is really interesting, and you both can provide digital technology and allow the customer. I've seen some partners of ours that are putting QR codes or other ways for people to use their personal devices in the context of the branch to actually complete a transaction. And again, maybe they're talking to a consultant around what's the right product or fit for me, but the actual fulfillment of that doesn't need to be necessarily human mediated or even
Right.
completed in the moment, right? And the idea of integrating either the bank's technology or the technology. Most of us bring a supercomputer into the branch with us in our pocket, right? That's more capable. I always kind of tell my kids, we've been watching. My kids are very interested in all the SpaceX stuff and the launches, and I go, they sent a man to the moon, and the computer that they used to do it was like a lot less powerful than this thing I hold in my pocket every day. It's kind of amazing what that technology is, and we're bringing it everywhere. And it gives you a footprint to leverage for that digital interaction that doesn't have to be provided by the institution in the context
Right.
of the branch.
Yep.
So I did want to ask you one other question before we get to some of the crazy new stuff, which is, um, have you seen a shift? I know right now is an interesting environment as interest rates are rising. All the institutions I know are thinking about the kinds of product mix they want on their balance sheet. But I'm always interested about to your point about putting the customer experience, the consumer's perspective at the core of what you do, a shift in the products that consumers want versus like what we as institutions might think is strategically the right fit for our balance sheet. And there's obviously both of those are important. But have you seen? I'm talking about personal loans are growing largely. Buy now, pay later has
Mhm.
kind of come out of nowhere to being a very big thing. And I'm curious if you see any trends about the kind of products that consumers are looking for that kind of unites the different things we're seeing happening in the market.
Yeah, absolutely. We for the past 3-4 years, we've ridden the gravy train, very nicely with the mortgage refinance business.
Mm-hmm.
Um,
That
Rates
only gets
have
harder when rates go up, though, Greg. I mean,
well,
rates go up, that business starts to become harder and
of
harder to
course,
grow.
of course, and that's where I was going with this. When first mortgage rates go up, we see the volume on home equity loans and lines of credit go up significantly.
Mm,
We're just coming off of an absolute record first quarter at Kemba with home equity lending. So I can't say that we're seeing a decline in that business at all. Um, but the more interesting one that you mentioned, Jeff, is the BNPL, the buy now pay later. That thing is on an absolute tear right now.
mm,
It's in 2016, and I'm trying to get my numbers right. In 2016, the BNPL payments accounted for less than 0.4% of the total e-commerce business.
mm,
This year is going to be at 3%. That is an absolute huge increase. Europe actually is way ahead of us with this channel. Finland, 25% of the population uses BNPL. Germany, 20% of all e-commerce payments are made through
wow.
BNPL. In the U.S., this year, we're looking at about $49 billion in e-commerce that will go flow through
Mm,
BNPL. In 2028, we're expecting that to be over 400 billion. Now, people like buy now, pay later for a lot of reasons. Number one, it's convenient, it's easy. All you got to do is click a button basically, and you're done. There's no credit check. There's no
mm,
whatever verification is done is that done on the back end, that is done within 2 seconds. Some folks like it because it doesn't report to the credit bureaus. Well, that is likely to change in the near future as some
That seems
regulation is
unsustainable. Like in
right.
the long, if it's more and more
The
debt moves there, that feels unsustainable as a strategy.
Yep, absolutely. But I think the danger with BNPL is it oftentimes puts people into payments that they cannot afford, and they
Mm-hmm.
themselves don't think or don't know that they cannot afford. As a trend itself, as an industry, I absolutely love it, and I think it's something that credit unions should definitely get involved with. Um, Personal loans. You mentioned personal loans.
Mm-hmm.
Again, another product that's been that has seen a very strong upswing for the last 3 or 4 years. Again, thanks to the experience of fintechs, thanks to how fintechs or AI in particular has made lending more available, especially to the underserved,
Mm-hmm.
where traditional data is being used in credit decisions. So there should certainly is a shift in the products. I think the biggest impact that we're going to see is the BNPL, no doubt.
Yeah, it's been a fascinating one, and I've been curious to watch the rise because you talk about ease of use, and I kind of what maybe I was an early skeptic, and I thought, well, I got a credit card in my pocket. It's also pretty easy to use. It's not that challenging, but it's been really interesting to see the adoption of BNPL. Replacing credit cards for some purchases, and what it is that's driving consumers to make that choice is really fascinating to me. Because it was not obvious to me that simplicity of use was that much of an upgrade from the status quo, where credit card my credit card works pretty well everywhere I go. They swipe it, or now I got to shove it in or tap it or whatever. But it tends to do the job.
But hey, BNPL is a very popular product for Gen Z and the millennials.
Mm-hmm.
So we've got to take care of it. We've got to address it.
We got to be there, and again put that consumer's desires at the center of what you do, and find a way to
Yep,
meet their needs. Um,
exactly.
we were talking a little bit before we started recording, and you had mentioned crypto. I don't know, what are your thoughts on the state of crypto? Is a credit union in Ohio going to get into the crypto game? Where do you think that sits as it relates to the banking industry as a whole, not just the kind of wild west of your MetaMask wallet?
Um, Crypto's here to stay. We need to we need to face that as credit union executives, and we need to accept that fact. Crypto is here to stay. The way crypto is regulated or not regulated today will change. There is talk now of having a U.S. government back
Mm-hmm.
crypto. Now, if that happens, or I should say, when that happens, it will allow financial institutions to work with consumers to allow them to do more with the crypto, because with the regulation, there's going to be a higher sense of security by the credit unions or by the banks. If we were to use crypto today, or if we were to offer such a service to our members, we would do it in the exact way that we allow them to buy stocks currently, right? You can buy a stock, and you can use that stock as collateral for a loan. If the stock
Mm-hmm.
certificate as collateral for a loan, at some point in the future. If we were to do that with crypto today, we would do it exactly the same way. But using that as collateral on a loan would be highly doubtful, because there really is very little reliability on the the value of that crypto, depending
Mm-hmm.
on what it might be. I think it's here to stay. I think there are some credit unions in Ohio who are looking at offering crypto, but again, it would be in the form of a partnership with a Coinbase or a Robinhood or something like that would allow people to buy crypto through the credit union. There's still a lot at stake as far as reputation for credit unions, and I think that's one of the things that still sort of holds us back from getting into that
Mm-hmm.
business. That a lot of people, excuse me, are still not sure what crypto is. They're still not sure how to make money on crypto or how to invest in it. And we're still reluctant to put members in that position. We're still, we have a fiduciary responsibility really to
Mm-hmm.
do what's right for the member. And the crypto issue is still it's the jury is still out on it. But I think eventually we're gonna have to adopt and offer it.
Yeah, I'm really interested in what happens when financial institutions. I think you're right. Most financial institutions that I've seen are in the crypto space, in the you can buy it, you can sell it, you can hold it. I haven't seen a lot moving to use it as collateral for a loan, although that certainly is possible. There's just custodial things you can do in crypto to make it truly truly collateralized in some more committed way. But I think the interesting thing will be to see if we start to see products or experiences built on top of crypto that are not just buy and sell like an asset, but actually integrate into the experience. And I haven't seen any of that really happening yet. We see it in Web3 outside of the financial services world, but that'll be
Right.
a really interesting thing to see what kind of developments happen where we're building on top of the blockchain, the crypto ecosystem to deliver new kinds of experiences, not just to hold some Bitcoin or some Ethereum or some, DAI or whatever in your wallet.
But wouldn't it be cool? Wouldn't it be nice to have a consumer make a payment on their loan with crypto?
Would be interesting.
I mean, that would really be something. I think that, if we get to that point, I hope I'm still alive when we get to that point. But I think that would be just an absolutely awesome thing to see.
Well, I think crypto is going to, so many things in when you think about change. I think that old phrase, it happens slowly and then all at once, is true, and we're in the slowly part. But my guess is the all at once is not that far away, where you start to see that certain things work, certain institutions adopt payment mechanisms or distribution into crypto or acceptance of crypto in real time for payments of things. And hey, if there are users who are holding a bunch of stuff in crypto and want to use that as a payment vehicle, then also, I see the opposite now. People don't want to pay in crypto. They want to do the opposite because they think crypto is going to keep appreciating, and they don't want to
Yep.
sell their crypto to make a payment on a traditional asset. They'd rather use this collateral to borrow the money to do whatever it is they need to do, because they're believers in, most of the holders of crypto that have decent holdings are believers in the
Right.
long term trend upwards of the valuation of those currencies. But yeah, it will certainly be an interesting time, and my guess is the future is coming faster than we may think. As that stuff starts to play out in the real world. Well, Rick, I've got three questions that I use to end this podcast every week. Kind of gotten into a rhythm with them. I don't even have to have them written down anymore. But I figured I would ask those to you now and get your opinions here before we end the conversation. And the first one is, what's the best piece of career advice you've ever got?
Career advice, I would say, never settle.
Never settle. That's good life advice,
settle.
I think, not just career advice. That's
True.
good life
Never
advice.
settle. Never accept the status quo. Always push the envelope. Just be careful. Be careful how far you push the envelope. But yeah, I think that's probably the best career advice that I ever got.
Never settle. All right, I like it. That's what I tell my kids too. Never settle.
Yeah.
Second question: what's the best piece of advice you've ever gotten about consumer banking or consumer lending?
Make business decisions and not credit decisions. This is something that I often work with my people on, with my team on. Just because we have this matrix of credit guidelines between a FICO and a DTI and a this and a that. This is not the world. This is not the world that our members live in. This is not the world that consumers live in. There's a million other things that come into play when you make a decision or a credit decision. And I always encourage them when I push them to make business decisions. The first thing I always tell them is, don't ever come to me and say, I've got a 600 member, or I've got a 750 application. This is not the way to make credit decisions. This is not the way to evaluate whether you make a loan or not. Look at the totality of the situation. Look at the profile. Study and understand the profile of the applicant, regardless of what kind of loan it is, and make a business decision, not just a credit decision. If I'm going to make credit decisions 24 hours a day, I don't need any human intervention. But no matter how digitized or how automated we get, we're still in the people business. We're still in the human business, and we need to make decisions to really take care of the folks that we serve.
Interesting. Make business decisions, not credit decisions. I like it. And my last one, what's one bold prediction for the future? It's always my favorite.
I think consumer lending, the future of consumer lending, will really be in the hands of new market entrants who introduce more AI or better AI and better decisioning models, where less and less emphasis is being placed on FICO scores. Um,
Mm.
and I think with that, consumers in general will have more options and more power to manage their payments. I think the future of consumer lending really is going to be controlled by the consumer. They're going to
Mm.
dictate, and they have for the past several years, they're going to dictate to us how we should run our business, not the other way around.
All right, that's a pretty good bold prediction to end on. Rick, I appreciate your taking the time and joining me today. Thanks so much. And I'm sure the guests will appreciate all your insights.
Thank you, Jeff. It's good to be with you.